Hello, my name is Clancy and I'm Managing Editor of Engaged Investor and Pensions Insight magazines. I'm here today with Andrew Kirton, who is Global Chief Investment Officer at Mercer. Andrew was of course featured in Pensions Insight's top 50 most influential people in pensions and has kindly agreed to be interviewed today. We're going to be speaking about pension fund investment themes for 2011. Andrew, welcome.
Thank you.
What investment themes for 2011 in terms of opportunities and risks do you broadly anticipate for pension funds?
Well, I think now is a very interesting time for pension investment globally. The fallout that we've seen from the financial crisis has actually, on the one hand, created a large number of investment opportunities. I can talk about one or two of them. On the other hand, there are some risks lingering around. So from an investor perspective, it's going to be a year, in our view, a pretty uncertain year. There are potentially still some shocks out there. But at the same time, if you're picking equities or you're picking certain types of bonds or alternative investments, the array of investments at reasonable prices out there has probably not been as big as it is now for 4 or 5 years. So a lot of opportunity, particularly for, should we say, relatively brave investors, but there are some risks attaching. Probably the biggest risk is from government bond investment. For pensions, it's the least risk asset class, but there are some issues on pricing, particularly in this market. We think gilts and index-linked gilts are expensive. So in a way, a sort of perverse, perhaps, situation where your least risk asset class is costing you a lot of money, but some of the growthier type asset classes, which have a use, have purpose within a pension scheme, more opportunity than we've seen for some time, all sort of wrapped in quite a high degree of uncertainty.
Do you think there's a paradox at the moment, which is that trustees are extremely risk averse for understandable reasons, but as a group they're taking risks on bonds? They're steered towards bonds by consultants and government as a match for their liabilities, but this type of herd movement is contributing to creating a bubble?
Well, I think there is a paradox, but I'm not sure it's creating massive risk. It is creating some risk. The least risk asset classes for a UK defined benefit pension scheme, i.e. those assets that perform most alike with the liabilities, are government bonds, conventional and index-linked gilts, and particularly index-linked gilts. That's a limited market. There are a lot of investors chasing inflation protection that you get from index-linked gilts, hence that market is expensive. And the way I think we would look at it is the price does matter. You're having to pay a high price to take risk off the table, and for each client, each set of trustees, the consideration is the same, but the answer may be different. You have to weigh up your need for protection against the price that you're paying for it. But yes, I mean, we think in index-linked gilts, we think they're expensive, and we think there's a real appetite out there to find other ways of taking risk off the table, or at least mitigating risk, whilst avoiding plunging headlong into expensive assets such as index-linked gilts. But the key thing here is that there are some investors that really have to pay the price, that there is good reason for some to be at the head of the queue in buying what look like expensive assets. And the way we would look at it with clients is first to examine what is your need to take risk off the table. Can you finesse it? Can you behave flexibly over the period ahead?
How soon do you think we might see issuance from the Debt Management Office of CPI-linked gilts?
I don't know. I mean, they've been pretty reluctant to issue index-linked gilts in recent years, and certainly in different fora, there's been a fair amount of lobbying for issuance. I mean, their issuance is based around government needs, not about the needs of pension schemes, unfortunately. You would have to issue a hell of a lot of index-linked gilts to bring demand or potential demand in line with supply, and I think it's going to be an issue over the next few years as pension schemes seek to de-risk.
A survey recently found that around half of trustees believe they're being fed a house view by advisors. Is this an accurate depiction of the relationship between trustees and their consultants?
From my experience, a lot of trustees, a lot of clients want some individuality from their consultant, and indeed part of buying services from a particular consultancy is the individual that leads the account and provides the actual advice. I think there's a balance to be had between the individual, hopefully skilled, hopefully experienced, hopefully having insight that adds value, and the value that the organisation brings. Consultancies are intellectual capital machines, and in a large consultancy there would literally be hundreds of people playing a part in generating intellectual capital. So inevitably it's a team game. Within my organisation we have people that are strategists, that we think there are some big themes out there that we think should be taken to clients. So to us it's about getting a balance between having a house view and bringing the strength of the organisation with some individual flavour. And I think you have to work at that balance. It doesn't surprise me that there are some trustees that worry that they're getting more of the organisation than the individual. Presumably there are some other trustees that think they're getting more of the individual than the organisation. I think what we've always strived for, and we think that the best of both worlds, is to get sort of top-down themes from the organisation, the take on those themes, and the individual input from consultants. It's not easy to do, and a lot of it, of making it a successful experience for a client is the nature of the relationship with the individual and how they can interpret what the organisation thinks and believes into advice that's good and pertinent for an individual client.
Mercer has moved from being purely an investment advisor to providing implemented consulting services in recent years. Why is this, and should your advisory clients be concerned?
Well, the reason we've moved is because there is demand from our clients for what we would call implemented services. And I think that demand is coming for a couple of reasons. I think one, in general terms, the investment world has become much more complex in terms of the range of asset classes and some of the technical considerations with particular types of investment. It's arguably more complex than it was 10 years ago, and certainly more than 20 years ago. A lot of decision makers in the pensions field in this market are lay individuals, and they're limited in time, and they're limited in how much they can devote to investment and all the other responsibilities they have that come with being a pension trustee. So I think you can explain part of the trend towards outsourcing responsibility for investment, if you like, to the general complexity of the market. I think there's a second issue, and that is to do with pension schemes maturing. The vast majority of private sector pension schemes are now closed. They are on a journey to full funding and to taking risk off the table anywhere between 5 and, say, 15 years from now. There's a finite point. Many of those schemes today are not fully funded. They can't take risk off the table without any other considerations. The journey is going to be a relatively tricky one. You can put together, and indeed we do, a suite of investment exposures and techniques which allow for that journey to be undertaken in a rational way, for the assets to be managed dynamically, so that at times where funding position improves, you lock in gains, for example. The degree of complexity involved in doing that successfully, again, is a multiple of what the way that some pension schemes have been managed in the past. So I think that there's a rational reason why such services are being demanded. Consultancies such as Mercer have the skill set to be able to deliver such services. We feel that it's perfectly reasonable that we're able to offer them to our clients in addition to advisory services. But you highlight the potential risk. There is a potential risk that if you're getting paid more, for example, for taking more responsibility, that somehow you neglect your advisory client base, or if there are limited capacity investments, that somehow you bias your best pieces of advice, so to speak, towards your implemented client base. All of that has to be managed, and I think we're acutely conscious that unless that's managed well, you can very quickly lose your reputation and lose your advisory clients. We have various protocols within Mercer that are designed really to create and preserve a level playing field between our advisory clients and those clients that have asked us to take discretion on their behalf. Those procedures are sort of actively reviewed, and we think they're pretty robust in preserving that level playing field. But that is in part how I think consultants, as they become more complex animals in terms of the range of services they offer, I think that is one of the ways in which our clients, I think, will look for evidence that we are looking after their interests, looking after the interests of all of our client base, and not being sectional in our attitude as our business changes and evolves.
Thank you for coming in, Andrew. It's been an interesting interview.
Thank you very much.
That's been our second interview with the top 50 most influential people in pensions. Look out for more on their way.